Hello and welcome to the tutorial on how to run the numbers for the Rehab and Refinance Property Analyzer. You can get to this section by going to Bonuses, scrolling down to Analyzer / Rehab and Refinance, and this window, this screen will appear. As you'll see, I already have all the numbers loaded into this software. After you input all your numbers, you click on Save. It brings you to the next screen, which you'll see in a minute. But what it also does is it actually saves your property here, gives you a nice drop down so you can refer back to any of the properties, and actually saves it based on the property address, and then in brackets it also gives you the date that you analyzed or did the analyzer on. Now before I get into this, into all the numbers here and all the different cells, I want to mention a couple things. One, all of the cells are currently filled in right now. Now, don't pay attention to those numbers. This is not an actual property. As you'll see, every single cell has numbers in it, and the reason being is I'm going through and double checking, ensuring there are no errors within the calculations. So that is why it was all filled in, and so none of the numbers actually will make any sense whatsoever in regards to any property. Secondly, I did want to mention I'm going to go through a lot of the stuff fairly quickly that was already covered within the the buy and hold tutorial. In there, I dig into and explain all those numbers. So if any time that the numbers are duplicated and within this software, then I'm going to breeze over those fairly quickly. So do yourself a favor, go back, check out that tutorial first before you go through this one. Okay. So first we have property information form. It's the exact same as the buy and hold. You have your address, asking price, purchase price, abatement, which is explained more in depth in the investment strategies section of the course within one of those tutorials, or more than one. And then you have your commission, real estate commissions on the sale of the property, and then of course your expected appreciation per year for that property within that city. Renovation information, this is new, not on the other software. As you'll see here, we have best case, expected, and worst case scenarios. And those are fairly self-explanatory. So for each one, obviously, you're going to put in the appropriate numbers based on which scenario you're evaluating. Immediate renovations, very straightforward. What do you expect to spend on the renovations? These numbers can all be the same. You might say, well, best case, expected case, and worst case, I'm always going to put in the same amount, and you may choose to change up your contingency fund here. As you see, contingency funds a percentage of total renovations, and we take a look at the note, typically 10 to 20%, depending on age of building and extent of renovations. Now that's important because if you have an older home, there's going to possibly be more things that turn up the more with the renovations that you're actually doing. If you have a 10-year-old home and putting on some paint, it's nothing can really kind of pop up a major issue, a major problem, where if you have a very old building and maybe you start taking things down and notice that there's knob and tube wiring in behind. All of those things can take into consideration when you have those older homes. As well, with the extent of the renovations, like I had mentioned, if you are just putting click laminate flooring over top of the existing flooring, not a big deal. But if you're tearing up the current floor that is there, then you may have joists rotting out, or you never know what's underneath of that flooring, so you may have more issues. So therefore, you should have a higher percentage contingency fund based on what renovations you're doing, as well as how old the building actually is. Next is your expected period of renovations, and this is number of months here. So we take a look, it says time of purchase to the time of refinance. So that's a very important note. It's not when you are done the renovations, but it's you finish renovations, then you're going to want to fill all the units before you apply for the mortgage, because the mortgage company is not going to feel very comfortable renting out or giving you a mortgage on a property that's empty. So you got to give yourself time to fill those vacancies, and then you have to give yourself even more time to apply for the mortgage afterwards, and then for it to actually close. So this is not just to the extent of renovations, but there's going to be at least another, say, 2 months based on filling the units, which you got to give yourself at least 30 days, and as well as going through and getting that mortgage. So That's the number of months here is what you expect for the whole process, the time that you purchase, the time that you actually have it refinanced. And even if it's going to stay filled for, say you purchase a place and the current tenants agree to get out 2 months after you purchase it, well, that's, you still take that in consideration. It says time of purchase to the time of the refinance. This software really analyzes that scenario. If you're going to hold on the property for a few years before you do this refinance sort of thing, then this is not the software that you're going to want to analyze. You're going to want to use this a couple years down the road when you are actually going through that process. Current fair market value after repairs. This is what you expect the new appraised value to be after renovations. I know I stress this in the buy and hold software tutorial, but I'm going to say it again here, and the importance of being conservative with your numbers. Make sure that you have very good comparables to prove what the current fair market value after repairs will be. It's better if you can have your real estate agent has gone through those comparable properties as well, so they can sit there and say, hey, yeah, you're going to be doing the renovations up to about those standards. So, I think it's a very good property to compare yours to after it's all said and done. MLS listings don't do a very good job of giving you a true representation of how nice it is inside those properties for your comparables. So you're going to have quite the range from your best case to worst case scenario. And ideally, the ones that your real estate agent has more intimate knowledge on, that's what you're going to be basing your expected fair market value after repairs to be. Your worst case, obviously, you just pull comparables and say, okay, that's on the low end, and then of course your best case is what's on the high end. Mortgage information. So this is on your original purchase before the refinance. Okay. So we take a look. We have items. So we have our first mortgage, private first mortgage. So that, as you can see, this one says through the bank. If you fill out this line here, that is actually going to give you a mortgage amortization schedule and everything like that. All of these other mortgages, the private first, RSP, private second, promissory notes, personal line of credit, all that are interest only payments. As I've never seen for myself, I've never seen somebody give a private mortgage and have an amortization schedule attached to it. So these are all interest only payments. Where this first mortgage here through the bank, that's when you actually pay down part of your principal every single month with your payments. So another very important thing I want to point out here, it says term as in months. Most of the time you will see this in a matter of years, but the reason it's months here is because a lot of these private it's going to be short-term financing typically for while you're doing your renovation work. So that's why it's in a matter of months. So in this scenario, that would be a 35-year amortization. So the 35, all you simply do is take the number of years that you have it amortized over, multiply that number by 12. So for a 25-year mortgage, it would be 300 months. And then we see here we have obviously the mortgage amount. And then it says interest paid out per year. As you can see, for the first mortgage, that cell is not able to be filled in because whatever your interest rate is your interest rate. Interest rate paid out per year. I've already gone over this in the buy and hold section, so I'll do it quickly here. It's simply if you can pay out less per year versus what your total interest is going to be, then you are increasing your cash flow, paying less money out now, and really back-ending that interest payment when you pay off the mortgage. Personal line of credit is very straightforward. If you're using your own money from a personal line of credit, you are going to get charged interest on that. Even though it is your money, you still have to pay the bank. So if whatever you're paying on that line of credit, simply put that number in here. And it's important to figure out all of the interest that you're going to be incurring over the time of the renovations. So this is mortgage information on a refinance here. So we take a look. This is exactly the same as what you saw in the buy and hold software, so I won't go over this. I will go over this very quickly. First mortgage, it's the same note. This number here, if in order for CMHC fees to calculate correctly, it has to be 85, 90, or 95%. Then you fit, as you can see here, that with auto calculation, nothing changes. You can't change that. Total interest. Again, if you have a variable mortgage, enter the 5-year posted interest rate, and I explain why. And as you can see here, this says term. This is number of years now, because these are longer term mortgages. This is not for during the refinance section. So typically, I said for the refinance, they're going to be 1-year terms, or maybe even less, maybe slightly more, but they're not going to be the long terms because you plan on doing a refinance and whatnot afterwards. Now, second advance of first mortgage. This is a highly unlikely scenario, but I did put it in there in case you know, maybe you're selling it to your brother, or you're selling it to a JV partner sort of thing, and you can still do mortgage plus repairs. So be it. I just added that in, but this is highly unlikely that you'll be able to use this strategy within rehab and refinance. Expenses, this is the exact same as the rehab and hold. As you see, there's less things here, and the reason, because it does say expense information before refinance. So there's less things here. It doesn't have the heat, hydro, water, but I will touch on that later. It is down, there's an area down below that you can enter that information in. So we just have this here as just your fixed costs. So taxes, insurance, water heater, condo fees, and other. So as you can see, other says recurring monthly even if units are vacant. So we'll take a look at the note here. Could be for cable, internet, phone, pool maintenance, etc. Now, the reason it says recurring monthly even if the units are vacant, that's an important note, because as you can see, all of these items, all of these expenses are actually fixed costs. So whether the units are vacant or they're filled, you're still gonna have to pay your taxes, insurance, and so on and so forth, right? Actually, if you're going through an extensive renovation, some insurance companies, and it's longer than I think 3 months, some insurance companies will actually require you to get a specific policy that covers it being under renovations, because the whole place might be vacant. So check with your insurance company if your current policy can handle and will cover this scenario that you're doing. Always be upfront and open with your mortgage broker and your insurance broker. Give full disclosure. They'll make sure you have the necessary coverage. So this, like I said, this is why it's before the refinance, because your insurance might actually be extra due to the renovations that you're actually going through. Next, we have expense information after the refinance. So this is the exact same as the buy and hold. We still have the vacancy allowance, repairs and maintenance. We'll go through this. So this should be slightly higher than the average in your area. Your repairs and maintenance, we suggest a minimum of 7%. Depends on the extent of your renovations as well right now, as well as the age of the building and so on and so forth. So that really just depends. Minimum 7%, so you might want to go higher. And then cost to fill the vacancy, so we can see here it's a percentage of 1 month's rent or a flat rate amount. So if you're paying, say, $1,000 on a flat rate, then that's what you put in there. This here would be 50% of 1 month's rent. Of course, the property student rental, and then all of your other costs, including, as you can see here, we have the hydro, heat, and water, because this is after the refinance, so it's asking you what's going to happen afterwards. So those variable costs are in there. Closing costs on purchase and the refinance. As you can see, a lot of these things are the exact same as a rehab and hold software. So we'll take a look. As you'll see here, mortgage penalty. This is new. It's not in the buy and hold software tutorial. So we'll take a look. Some mortgages will charge a penalty for early payment. Be sure to ask what this amount is before signing anything. So we are obviously going to have mortgages on when we first purchase the property, when we're going through the renovation, and depending on who you're with, if it's a private mortgage or whatnot, you may have mortgage penalties. So make sure to ask what that would be. If you are going through a bank and then just refinancing with the bank, then you shouldn't have any mortgage penalties. The reason being is you want to get yourself into an open mortgage, so that means that you can refinance or get out of that mortgage at any point in time during the the term that it's actually on. So you might have a 1-year open or a 2-year open sort of thing, and that allows you to do a refinance or whatever without incurring any penalties. Typically, I think it's minimum 3 months worth of interest to get out of mortgage from a bank. And it could be different depending on which bank you're with. As well, for any private mortgages, that's how they will ensure that they actually make their money, is they might say, it's for a 1-year term, but if you want to pay off this mortgage early, then it's going to cost you X amount of dollars or X amount of months worth of interest. So just make sure you ask those questions before you get the mortgage and ensure what it is, and then just whatever it is, try to negotiate your best deal. But if you have to pay money, then you have to pay money. As long as you're including the cost that you're going to be out of pocket within this software, within these numbers and analyzing it, then it doesn't really matter. You can pay as many people as you want. If you're still making good money on it, then still move forward. Lawyers' fees, lenders' fees, brokers' fees, building inspection, appraisal, title insurance, other supplies and furnishings, those are all the exact same. So if you're going to put in any furniture or anything like that before, as you see, on purchase or on the refinance, just do it. The only one that would be slightly different is this reserve fund here. As you can see, I have $10,000 and then negative $5,000. Now, what we've done here is because typically you would only have a reserve fund after the refinance, but some people want to have a higher reserve fund. Say they put the renovations all the exact same amount, and they're going to say, okay, well, maybe it could go, I might do the roof, or I might do extra insulation depending on what the eco-energy retrofit says or whatever. They might sit there and say, I'm not sure if I'm going to do something. I'm going to put it over here in the reserve fund. So you get $10,000 just in case other things come up. But then you're saying afterwards, well, I don't want to keep $10,000 in my reserve fund for this property after I do the refinance. So I'm going to take $5,000 back out. So if you add these two together, that's what your reserve fund will be after the refinance happens. So if this was $5,000, this was negative $5,000, then you would have $0 in the reserve fund after you do the refinance. And we always suggest minimum $5,000 because you never know what could happen. The furnace could go or whatever, even though it shouldn't, or you might think it's under warranty, but it might not be. You never know what can happen. So we always suggest keeping money there. And the best part about that is that $5,000 that's sitting there is still going to make you the same percentage returns as what is projected. So it's still making you money. Prorated rent on closing, RSP lender fees, account setup, environmental study phase 1 and 2. Those are all, everything else is explained in full detail within the buy and hold tutorial. Income during renovations. As you can see here, you would input a number in, hit save number or unit number. If you have, as we'll see here, if I type in 7, save unit, comes down here, there's another one that shows up. We'll take a look at all of the notes here. Monthly rental amount, that's pretty straightforward. So this is, you would simply enter the amount currently being received if the unit's filled. And if it's vacant or you're adding a new unit with the renovation work, then simply enter $0. So say it's currently only a 5-plex, but you're adding a 6th unit, so you would just simply enter in 0 there. Number of months vacant. Now this is an important one. If the unit will definitely be vacant during the whole renovation, simply enter the same number of months for expected period of renovation under the worst case scenario within the renovation information on the second drop down window. So we'll take a look at that right now. We'll go back up here, take renovation information. It said expected period of renovations in months. So we look at the worst case scenario and it's 8. So if we take a look here, if you know that that unit is going to be vacant during the whole 8 months or during the whole amount of renovations, no matter how long it's going to be, then you would simply just enter 8. If that number up top is 20, then you would simply enter 20 into these cells here. Okay? If it's going to be anything less than that, then you simply enter in what's expected. Then we have utility costs per month. Take a look at this note. Includes only heat, hydro, water and sewer, and other expenses, nothing else. Do not duplicate the expense information listed above. That was in this area here. Oh, before refinance, that was this area. Don't duplicate any of those things here. Okay? This is where those variable costs come in, like the heat, hydro, the water, those sorts of things, because when it's filled, you might have part of the unit inclusive, or maybe it's actually all plus utilities, so then therefore these numbers would be zero. At the same time, maybe it's all inclusive, so maybe these numbers could be much higher than when it's vacant, because when you have somebody in the unit, they're going to use more water, electricity when it's filled versus when it's vacant. So when it is filled, you simply enter in what your utility costs will be when it's filled, and then over here how much they would be when it's actually vacant. And remember, it is only the heat, hydro, water, sewer, and other variable expenses like that. And lastly, we have income information after the refinance. Simply enter the number of units. Come down here, the monthly rental amount. As you'll see the note. After repairs have been completed, if no repairs, then input the current rental amount. So if you're going to increase the rents based on the renovations that you've done, put in the new amount of rental income that you're going to be getting. If before, say you're getting $795 and you're not touching the unit, then just simply enter that same amount, $795 again. And then here, needs to be filled out, yes or no. So when it's checked, check mark means yes, it needs to be filled. The reason we fill this out is so we can include the cost that it takes to fill every single one of those units. Whether it be a percentage of a 1 month's rent or a fixed cost, whatever it is, we need to ensure that we are calculating that expense. Then we come down and we click save. Okay, so it'll take a second there to load, and once it does, it'll take you to this page here, and this is really where all of the analysis work is done. Take a look at all the numbers and figure out if really this is a good property for you to move forward with. The first drop down is in the investment tab. So we look, it says gives us a purchase price, the total amount of the mortgage we have on the property, what our monthly costs to hold that property. That would be your more of a fixed cost sort of thing, but that stuff up there is not really important. All of these numbers down here are very important to be looking at. So we take a look at the length of time for the renovations, and as well as the rental amount. Now, I didn't mention this when I went through running the numbers there on the last page, but I did want to make a comment in regards to when a contractor tells you how long the renovations are. Like, say he expects 2 months, I would use his expected as your best case scenario, and then add on more months for your expected in your worst case scenario. If a project is running on time, in my opinion, that is ahead of schedule, basically. Typically, all renovations that we have done, or majority of anyway, have gone over in time. Whether it be a couple of weeks or quite a few months, it all depends on the property specific and how much work you're doing, so on and so forth. So if he says 2 months, and then of course you give yourself a month to fill the unit and a month to do the refinance, will give you 4 months as your best case scenario. Now, you have to understand too, when you're sitting there, and under this scenario we have 4, 6, or 8 months. That's a decent amount there. Now, if the expected amount is going to be a year, then you have to remember it's all relative, right? Like, this is only going up 2 months at a time, but if it's going to be a year or 12 months for your expected, then your worst case scenario should probably be more than 14 months, because it's not a very high percentage increase from one to the other. So if it's only going to be a 2 or 3 month project, you can expect 3 or 4 to be your kind of worst case scenario, and then on the other side, if it's 12 months, you might want to put it 18 months for your worst case scenario sort of thing, because you really never know what can happen. So make sure you are being conservative. Now, for the rental amount, this is an interesting line. Unfortunately, with the software, we had a lot of troubles trying to factor in different scenarios. So I'm going to go back to the input side here for a second. And as we look, the expected period of renovations under your best case scenario is 4. And if we go to scroll down here and we looked at the number of months vacant, as we can see, there's only one number under 4. So that's that 495. So this unit 1, what it's saying is it's going to go vacant for 3 months, and then you're going to collect 1 month worth of income because it's 4 months worth of renovations. It's only vacant for 3, so therefore it takes in 1 month of rent from this unit. Now, the software does not add in or determine whether that rent is coming from the new higher rental amount. So you did work here, as we take a look in this scenario, unit number 1 then rents out for $795 afterwards. Well, the software cannot decipher whether this 1 month that it was not vacant, whether that be at the $495 or the $795. So that is a slight, I guess, not necessarily shortfall, but the software, we couldn't find a way to program it any other way. So it will always take this rental amount into consideration, not the income after the refinance. So if you are going to get more rent, make sure that you change those numbers on a piece, like for yourself mentally. And everything else, 4, 5, 6, 7, 8, all these are 4 or above. That's why it doesn't include any other rents from any other units, because it's assuming that they're all vacant for 4 months as well, because that's your best case scenario here. So like I said, for that rental amount, just figure it out if you are going to be getting a different amount of rent, and simply just take that off of what your money in and out of pocket is going to be. So of course it adds up all the renovation money. As you can see, it includes a contingency fund. So whatever percentage that you've set aside for contingency, it's going to include that. Then you have your mortgage payments, all the different ones, and then your property expenses. It summarizes all of those. Or no, sorry, the property expenses is for all of those fixed costs. So your insurance, your property taxes, things like that. Then you have your utility costs for all the units. That would include whether they're vacant or filled. Whatever you put in, it'll figure out exactly when it's vacant, how much it costs you, when it's filled, how much it costs you, not all those together. Then you have your closing costs. As you see, it says from purchase only. So it has nothing to do with the refinance side. This is just from your purchase side. Then it has a land transfer tax to add in there because you're buying it. How much it's going to cost to fill all the units. And then gives you a total of all those expenses. Everything up here gives you that total. And of course, that total also includes you getting money from the rents. Then it says, okay, well, under each scenario, we're going to have a different refinance amount and the new first mortgage based on that, whatever the information that you put in. So it says, okay, it costs us X amount. It's going to appraise out for this, so we're going to get a new first mortgage of this, and then the total amount owing on the property is $477,000. The reason being, so we have this how much it costs, and then we have to add in the total amount of the mortgages that we actually have to pay back on the property as well. So that's how much is actually owing out. So money in or out of pocket, best case scenario, this under here is $71,000, and over here is the worst case is $200,000. But this is not an actual property, but that's just kind of how it all breaks it down. These are very important numbers for you to be looking at here, figuring out what you're going to be in or out of pocket. And that incorporates, and I'll show you later on within the drop downs how that comes into play. But that's really how you read this investment drop down window. Next is all numbers. This is basically the exact same as what is in the buy and hold tutorial. So I'm not going to go over everything. What you really want to be looking at, this does summarize everything nicely. Gives you your income coming in, all of your expenses, different, your fair market value, what it's going to be, whatnot, number of units, all that stuff, figuring out all the mortgage information, all that. This row or column is that is all of the deferred interest. So what you have is, we're only going to pay out 3% yearly, but they're actually earning 12, so we're back ending 9%. While over that period of time, however number of years, however long that term is for that mortgage, that is all of the accumulated interest that's going to be tacked on when you go to pay back this $15,000. You'd pay back 15 plus the $6,750. So that is what this column is here. The debt coverage ratio, I've touched on this in a different area, but if you're sitting at 1.1 to 1.2, that's a decent range. Obviously, higher than 1.2 is good. So you want to take a look at that. That's a decent number because that's what the banks look at as well. Now, one of the big things here is you'll see this total money invested after refinance is a drop down window. Now, as you can see, there's three different amounts: 71, 148, 197. So if we go back above, we take a look: 71, 148, 197. So it's determining what our best, expected, and worst case scenarios are. So we'll take a look quickly. So, you know, fair market value to prepare is 455 or whatnot. So let's go best case scenario. As you can see, all of these numbers change. You know, a debt coverage ratio is 1.12. The fair market value is $525,000. So everything changes whenever you change this. So this is your best case, always be the top number, your expected case scenario, and your worst case scenario. Now what we've done here is if you're actually putting money in your pocket, which is possible after refinance. So it'll be, say this could be positive $71,000. What happens is this balance due on closing, this amount right here, that's what determines what your investment amount is. This will never be a negative number. So if you put money in your pocket, technically that it is supposed to be a negative number because you don't owe anything, you actually put money in your pocket. Well, it'll automatically go to $1 because all the other formulas will really mess up if that's the case. If something happens where this is negative, then everything will be wrong. And as you'll see here, when we go through, like your average ROI will be astronomical. It's going to be, you know, thousands of percent as opposed to like 20% ROI sort of thing. So really, your returns on investment, everything is infinite. If you put money in your pocket in a property after the refinance, then there's not really much to evaluate. Then you know it's a great property. You're going to want to move forward with it. Everything else really doesn't matter. Cash on cash returns, nothing matters. All gravy for you because you didn't have to put a dime into it. You might wonder why the debt coverage ratio is lower. Well, we're going to have a higher first mortgage, higher mortgage payments, and the income is staying the exact same. So that's why you're going to have a lower debt coverage ratio under the best case scenario. So as you can see here, it just takes out what that money was invested in the property after the refinance, adds in whatever your reserve fund is. Remember, in this scenario, I took I had $10,000 for the reserve fund during renovations, and I want to take $5,000 back out. So it adds in the reserve fund, your supplies and furnishings on the refinance side, and then of course your closing costs, which are all listed here, which you input on the other side of the software. Then we have the mortgage calculator. It basically shows you what your monthly payments are going to be, how many number of payments you're going to have, total interest, the total cost of the loan, you know what the purchase price is, loan to value amount, loan amount. Everything's fairly straightforward. What your interest rate you're going to pay is, all that kind of stuff. And then it breaks it down 420 months of payments. Next, we have the quick summary. It's the exact same as the buy and hold software. What you want to look at here is the yearly return on investment from cash flow and what your net cash flow is. As well, you want to look at what your average yearly return on investment is going to be. Those are your three big numbers in this area. Now, I did want to mention too, this is a really quick thing. I always come here because I can look at the numbers really quick. Every drop-down window gets more and more details for you, so that's what this really is. You don't have to worry about how we got to the 5-year total profits and 5-year equity and that kind of stuff. It's detailed later. Property executive summary. This is a little bit more detail. As you can see, the things that are kind of highlighted here is what you want to be looking at. You know, you get your cash on cash returns. You have your total, what you're going to gain over the 5 years and what that means for you as an estimated 5-year total return on investment. This is your cash flow breakdown. It takes everything in consideration, gives you all your different mortgages information, how much you're going to have invested in the property, what you're getting in rents. Then you have your vacancy, as we see here, is 5%. Gives us our income. So our market rents minus our vacancies give us our income. And then we have all of our expenses listed out, as you can see, to give us our total expenses. So then we have our income minus the total expenses gives us cash flow before debt payment. and then we have to pay down our first mortgage, our second mortgage, our RSP, or promissory notes, or whatever, which then gives us our cash flow after paying off all the debts. So that's what we're putting in our pocket. But it's also saying, well, don't forget we're paying down the principal each year, so that our mortgage is less. So we actually are making this money. So the total cash that we're getting is this, but remember that this is the real number here, is this cash flow. That's what you're putting in your pocket month after month, year after year. As you can see on the side too, it tells us our first mortgage payments at 3.5%, or 3.55. Repairs and maintenance of property management, it gives us those percentages just in case, so we know exactly what we did input without having to go back and look. Sensitivity analysis. This has gone over once again within the buy and hold, but I'll go over it slightly or quickly here. This basically says if we only hit 2% appreciation, 4% or 6% appreciation, how things change. And it's always important to look at sensitivity analysis, so we can see here our estimated 5-year profits, our total return on investment, and our yearly average return on investment. Those are really the numbers you want to be looking at. If it's only 2% appreciation, we're actually not going to be making any money. That could be a very good indication as to why you might not want to buy a property. If you're buying it only on speculation sort of thing, what happens if it doesn't hit that 4%? Imagine if it hit 0, then what would happen? It's even that much worse. So, be careful to make sure you look at these numbers and determine whether, that 2% appreciation, you still should be making money regardless. And lastly, this is just the appreciation, shows you how the property value increases based on your growth, what the amount is owing after every year, and then it shows how the equity grows. So this is a nice graph kind of showing how the property value goes up, the amount owing goes down, and it shows you again what the first year mortgage reduction is. At the very bottom we see here is all information PDF. Click on this quick, and what happens is it'll upload a PDF file that you can then save to anywhere on your computer, your hard drive, or whatnot. It's always important to keep an external file in case you want to take it to show somebody so you can't get on the internet. Whatever the case may be, it's always nice to have that saved somewhere else so that you can access it at any time. Open file. We'll take a look here. As you can see, it's the exact printout of what you'll see online, right? We have all of our numbers, cash requirements. You can see you can't really use that drop down. Mortgage calculator, amortization schedule, then a quick summary. So absolutely everything that you see online is right there. It's just in a nice printout for you, so you can save it somewhere else, so you don't have to have online access to look at the numbers and analyze a property. Because you could just click on that, save it to your phone, smartphone, tablet, whatever the case may be, take it with you and look at the numbers and analyze it at a later date. That's the end of the tutorial. I hope you enjoyed.